Is joining us is Stewart Paterson. He's Joint Managing Director at Riley Patterson Investment Management in Singapore. Now, your opportunities fund has outperformed the benchmark, up, 44% compared to the MSCI ex-Japan, which is down 51%. Okay, but you're pretty pessimistic despite all this, because we had Christine Lagarde saying that she didn't see it being so bad in Asia or emerging markets, but I believe that you don't see any bright spots in Asia.
Not really, no. I would disagree with her on that. I think the reality is that Asia is the factory of the world. And therefore, if G3 economies are going into recession, which it looks increasingly likely that they are, we will feel it very acutely in Asia, and that's really always been the case. So that will manifest itself in obviously negative export growth next year, I think, in the region, and a significant slowdown in growth here. The other issue, though, is the financial interconnection, which is that, European banks have lent a lot of money in this region in Asia. We could be looking at $200 billion of deleveraging coming out of this region, and obviously that's going to have a very pronounced impact on asset prices and currencies in this region. And I'm afraid, therefore, I think that the next year is probably one of negative returns for investors who don't embrace the bear market and get short.
Yeah, so she's right when she said no country is going to be immune. It's just, I guess, the level of immunity that we're talking about. But when we have a look at what she's been saying, it really is pretty negative when it comes from the head of the IMF.
Well, it's a lot more negative than when she was in her previous role. Perhaps she feels freer to tell the truth now. I think the reality is that Europe is in a mess, and that policy makers have failed to identify the core of the problem. To my mind, the core of the problem is that peripheral Europe is uncompetitive if it's in the same exchange rate as Germany. And that's manifested through unit labour costs that have outstripped German unit labour costs in, say, Italy or France by perhaps 35% over the last decade. That shows up in their balance of payments, and it shows up in the lack of growth, and it's that lack of growth which is causing the problem in terms of fiscal sustainability at the government level, coupled with the fact that the social contracts that governments have with their populations in Europe are too generous and have to be changed. And so policymakers really are treating symptoms at the moment rather than treating the core of the problem, and therefore I think it's too early to say that even we're at the beginning of the end of the euro problem. I think policymakers haven't even started to address the disease.
Let's just talk about the implications as far as it comes to investing. Now, with that in mind, and as I was saying in the lead-in, you're saying that people should be looking to buy equities when they are reduced to recession values. When do you know that they are at recession values?
Well, that's a good question. We've got quite a long financial history in Asia of markets and valuation levels associated with global recessions going back to the 70s. In our view, we're probably about 35%, between 30 and 40% away from recessionary valuations in Asia at the moment, looking at price to replacement cost or price to book. That's in local currency terms. Obviously, in the sort of scenario that we envisage of a global recession, a sharp appreciation of the US dollar as the euro devalues below parity, Asian currencies are likely to weaken too. So investors in this region, I'm afraid, could be looking at up to 50% drawdown from here before we find the sort of cataclysmic bottom that would be associated with the kind of recession that we're probably looking at a global level.
Very quickly, can China keep us out of the woods?
I think not, but I do think in balance that China will ease next year, but they don't have the resources to be able to embark on the kind of credit and fiscal easing that they undertook in 2009. I think the true cost of that has been very high, and that is coming home to roost now in terms of the numbers that we're seeing out of banks, in terms of where non-performing loans are going, and clearly also government financing in terms of what's going on with the property sector and local government finance. So yes, on balance, I think China will be a relatively good place to be next year. We will see some policy accommodation from them, but it's not going to lift the world out of the malaise that we find ourselves in now.
Stewart, thank you so much for your time.